Let's move straight to trade management. We just remind everyone first that we have two technical pictures. There's a bullish picture and there is a bearish picture. The bullish picture is what we're seeing here. We keep seeing fractals of local heads and shoulders. The one that we're in, the currently is market is in, is about to finish and break to the upside. Breaking the upside takes us to 159.60. We see double shoulders here. We see we've completed 4A, we've completed 4B, we've completed 4C. We're going to break out to 5. And of course, 159.60 is just at the top of the shoulder level. So probably we even went to 161, maybe over here showing 162. So this is the bullish picture. All right, and we break the shoulder levels, move higher before we do other shoulder levels or higher head levels. The bearish picture is that there is intervention by the Bank of Japan. The Bank of Japan gets serious. They have a cap at 160 and they're going to defend that cap. So market moves to 159.60. Bank of Japan intervenes. Market crashes. Remember, these are already shoulders. Crashes back to a level 3. That level 3 here becomes a buying opportunity at 155. Buys again. They intervene again. Market crashes this time. The people who bought at 155 take profits and dump, and the market crashes further down to 152, 150. Only on continuous central bank intervention. The central bank has to play smart. They know there is a strong resistance at level 1, or a strong resistance to the move, a strong support at level 1. To take it out, they have to continue to intervene, push the market to 150. Are they interested in doing this? Apparently not, because they did say that they were more focused on inflation and not on a specific FX currency rate. And that there is no inflation in Japan in the first place, so they really have nothing to worry them. There has been a new policy release that they are considering raising rates in July. Of course, the Bank of Japan, when they raise rates, it's going to be 0.1 or something, or maybe 0.25 at the most, but it could move the market. It could move the market to the downside around 162 levels, 161 levels, could move the market back to 155 levels. So they will still have held the 160 cap in place. It could be that that's what they're hoping will begin to cap yen devaluation or to stop yen devaluation. All right, let's take it to actual trade management. We were looking at this 45 minutes yesterday. Remember, the market, in order to do a second head, this is the old head, must be moving inside of an ending diagonal. This ending diagonal shows completion of a wave 1 and a wave 2, and it's currently doing a wave 3. That's why it's very choppy. So there's a wave 1 and a wave 2. All right, we're still doing 2C probably. We have a 2A, we have a 2B. We're going to be doing 2C. We're hoping to get entries at 156, I believe even lower, 155.80s, and 157.10 at the most. Or we can only break below 152.50 or 153 on central bank intervention. This is what we get today on the 45 minutes, and that's it. The 45 is more important than the 15 because it shows beginning of acceleration probably in the market. So it's still 4B. I want to focus on these labels. There's a 4B, there's a 4C. Traders here are a bit more probably cautious of central bank intervention. There has been a rumor today, because it is Juneteenth Day, that there could be central bank intervention because the Bank of Japan would want to intervene on thin markets. Today is a holiday in the United States, so it's an opportunity. If this is the case, 4C will shift to 155. You see this pale yellow labels mean you can still get a 4A, 4B, and 4C. We do the entries then at 156 and maybe 155.50, but I doubt really that we get any of this. This is what we're seeing today on the 45 minutes. Main focus must be that 1 and 2, because we believe instead of doing a B and a C, we've done an internal 1 and a 2. So we get here 1 and 2. That are 5 swings, 1 and a 2, 3, 4, and a 5. Yellow swings, of course. We'll probably have finished 2 altogether. and are doing the same fractal of leg 1. This leg 1 is a very sharp move higher. Dot 1 or internal 1 is a very sharp move higher. Are we going to get a retraction? Must only be 61.8%, 50%, the 200-point moving average before the market moves higher. So if you're interested in doing the longs United States dollar against the yen, it's a buy with a hedge below level 2 because we believe 2 is finished. We are not going to get a 2C. It shows an A and a B and a C, but I doubt. Not on positive momentum. Let's take it live. And of course, with the current move with the sterling yen, then of course the dollar yen will simply follow suit. Let's take it to 45 minutes. Check momentum. See, of course, continuity and will mean trending. We also have a cycle extreme at this point, which would mean that 2 is really finished. And we shouldn't bother. That is, of course, to become 2C. Like we're showing here, you don't really have any more ABs. This is too cautious. It's like a 1 and a 2, 3, 4, and a 5. You're only correcting this move, that's all. You also see some kind of an ending diagonal here, so the correction is really just for that leg 1 and leg 2. I'm referring to the Roman italics in yellow. No more 2, no more C. Very sorry. All right, so the best entry is really 50% and 38.2. 156.70, 157. That's it. If we have entries higher, or if we already have entries, we want to hold them. So let's say we don't have the entries, we're going to attempt to take it at 156.80. I believe we can get this as the pivot level, just below the pivot level. The pivot level is 157 today, or this week. Just below it is 157.80 and 157.90. So we should get 157.80. Hedges below level 2, below support 1, 155.50. So from 157.80 to 155.80 is 200 points. I'm sorry, it's 156.80 to 155.80 is 200 points, is 100 points. A bit lower to 155.60 is 120 points. So the entry is 156.80, 156.90. The hedge is 155.60. The target is the end of the week, or the target is resistance 2 on the 45-minute time frame today, which is around 159, I believe, 70. 159.66 is showing right there. We're moving, of course, in an ending diagonal. You see a 1 and a 2. At some point, we're going to have a sudden breakout to attack the upper boundary of the ending diagonal. So this is a bit too theoretical. If you just stand down to 156.80, I don't believe we ever get it. What we could only consider to get is the 200-point moving average. That's all. That is the best, I believe. 61.8%, 157.30. So we do the entry 157.30. We have a hedge at 156, 130 points, also still at level 2, but a bit higher. 156 is the hedge. The entry is 157.30 if you really want to get into the market. Right now, market is 157.90, so it's very high. The best entry is the 200-point moving average. Again, let's amend. Let's be practical. At some point, we're going to attack that 200-point moving average, maybe higher up. So if the market keeps moving higher, we always just have the entry at the 200-point moving average. And the hedge is about 130, 140 points from entry. Here in this case, if we're doing along at 157.30, the hedge is 156. The target is 159.60. 159.60 showing there as upper boundary of the ending diagonal. Possibly even 160.